Yeah, I think people aren't taking in account that it's an oligopolistic market, which it wasn't before. There's three players. When you see things, and signs like those three players acting rationally, which matters a heck of a lot more. I got that word heck right. A heck of a lot more than anything else than the demand side. The demand side is going to be good for a long time. Servers and the cloud, and if you have smart cars, I mean, there's just a great future for this stuff. It's historically been the supply side that's got this industry. When you had 8 or 10 manufacturers, you had a lot of chaos out there. Now you have 3. So what's happened, and what are people ignoring? They're ignoring the delay in manufacturing additions of Samsung and Hynix that they may have not delayed before, and that's been the announcement. That's the story. Oligopolistic power. Now, we made an investment years ago in another industry, way before the market. We're kind of here. We rode this Micron up because we were still making money on it, rode it back down again. We believe it's oligopolistic. We look at that stock, and we look at $10 billion of cash flow this year, enough to buy 20% of that stock back in. We're just starting to buy stock in September, which is a heck of a lot. My new favorite word, heck. But I can't listen. There's a lot of emotion among this stock. People have gotten. This is one of the most historically hated stocks in the world. I historically hate this stock, but there's new management. Management that was with SanDisk before, new CFO that seems to be, very good. They're buying back the stock. It's a little bit nuts. But listen, the market goes through things. There's moods in the market. I mean, I can't control those moods. And, sometimes I get in the mood, by the way, in the China thing, that will own nothing else. I'll sell everything else, get rid of my hedges, own Micron, and wait till the market figures it out.
What you just listened to was David Tepper, one of the most successful fund managers in the world, outline his bull case for Micron Technologies. And although this clip is almost 3 years old now and the price has also doubled, I believe the thesis is still very much the same today. David Tepper himself still owns Micron as his highest conviction bet in his fund, making up close to 10% of the total portfolio. He did trim it a little bit in Q2, but he's trimmed almost everything, as you can see. But if we just look at the lineup of super investors that are supporting this stock, it's like an all-star 7-a-side team. As you can see, Lilu, arguably one of the most talented investors on the planet. He has a 40% plus position for his portfolio. Monish Prabrai, too, around about 40%. And this suggests very high conviction for the future prospects of this company. Seth Klarman as well, the author of Margin of Safety and a value investing legend, increased his position in Micron this quarter, a 32% increase, taking it to a 5% bet in his portfolio. Interestingly, Sequoia did the same Sequoia that has a 60-year track record of beating the market. They added 54% to their Micron position this quarter, and this was actually a brand new position in Q1 when the stock was sitting around $80 to $95 per share. It's now around $73 per share for reference. And so with this all-star lineup of big bets on Micron, what is the investment appeal? As you heard David Tepper say, this is notoriously one of the most hated stocks in the world when compared to their business fundamentals. They're always trading at a relatively low discount to what they should be worth. Investors in the past, though, as you can see from the stock price, have dipped in and out or just chose to stay away from the volatility and cyclicality that a business like Micron possesses. But of course, this can be used to a contrarian investor's advantage. This is because when you boil down what is necessary to be successful in investing in the public markets, it's all about having an intellectual, informational, or emotional edge. You can do well by just having one of those things, but you can do even better in cases where all three can be applied. And I personally think Micron is one of those stocks where all three can be applied. And some of these super investors that we've just looked at have spotted that. And so starting at a high level, as Micron has historically shown traits of being a low quality business in a low quality industry, and what it actually does is very complicated, at least to people unfamiliar with the industry like me. It creates a theoretical wall that investors need to climb over in order to invest or make a sure bet on Micron. And this allows those acute investors or well-informed investors that we've looked at earlier to gain an edge over the market. The same market who would pass up on the opportunity due to both complexity and unpredictability of the business. But before I dive deeper into the bull case for Micron, let's cover why this is such an unloved stock and what some of the clear negatives are with this business. Firstly, is, of course, the cyclicality. As an overview, although I've done a deep dive on Micron already, Micron are a memory chip and storage solution business that produces two of the main three memory technologies, that being DRAM and NAND. It did produce 3D XPoint, but it announced its exit of that memory product earlier in this year. But as a result, Micron is in an industry that is prone to cyclicality, and the force behind this cyclicality is supply and demand. When conditions are favourable, chip makers have trouble actually keeping up with the demand, and therefore sale prices rise. But when supply exceeds demand, like it has done in the past, either through overproduction or a pullback in consumer markets, prices fall. In turn, so do the revenues and profits of the businesses in the industry. Second is high capex requirements. Again, the industry has high capex requirements as it's a manufacturing business. They need to continuously spend money on property, plant, and equipment to meet the levels of demand and increase or even maintain their production capacity. This is partially because of the nature of their business, but also because the memory technology they produce is continuously developing. Now, if we look at the hypothetical bull case for Micron, it gives us, at least in my opinion, a fair counter argument for both of those clear negatives that I've just mentioned. So to summarize, there are two sides of this thesis, or two drivers of value for Micron in the future. The first is increased through cycle earnings power, and that essentially just means that earnings of the business will continue to grow through the cycle, just maybe not in a linear fashion. Second is reduced cyclicality, which, if it happens, should lead to a better understanding of the business and a better appreciation of the business, and then potentially a multiple expansion. So we have two drivers of value there. Needless to say that if we have earnings growth and a multiple expansion, or even a sustained multiple to where it is now, there will be a significant increase in value in this business. Now, if we tackle both of these one by one and just dive deeper into the thesis a little bit more, give some context around these two drivers. Firstly, as we can see, even though Micron has been the victim of a lot of cyclicality, over time through the cycle, earnings have increased on average. Not just that, but also their returns on equity capital have improved through each cycle too. So that's what we talk about when I say through cycle earnings power. This tells us essentially they're selling more products, so demand is increasing through each cycle, but also that the unit economics are improving over each cycle as well, i.e., better margins. But what will continue to drive this improvement? Well, it is probably the new digital and information age that we're entering. DRAM and NAND, which are the two main products that they sell, but more specifically DRAM, are essential for computers, electronic devices, data centers, and AI technologies to function, and more importantly, develop. As these technologies improve, they require much more data storage and memory than in the previous editions or in the previous phases. And the consensus is that all these things will obviously be more prevalent and more important over the next decade in our world, thus leading to Micron and the two other players in this market benefiting not just from a near-term supply-demand equilibrium, but a steady surplus in demand versus supply over time. Now, the second point is reduced cyclicality. Now, I'm not saying cyclicality is going to be diminished, but the consensus is that cyclicality will start to die down, and then understanding or appreciation of the business will start to improve. So starting at a high level, what really drives cyclicality in the memory market and semiconductors in general? And it's supply-demand imbalances like we spoke about earlier. This in the past was caused by too many market participants trying to undercut or cheat out the competition by ramping up their production in order to achieve per unit efficiencies. And this is normal, but when you're in a commodity-based business, it isn't the most clever thing to do. But this in turn led to supply outweighing demand for a sustained period of time, driving prices down and therefore eliminating some of the weaker players in the industry. And so we're now left with an oligopoly. That's three main players who control the market, which in the future should produce less volatile supply trends than we have seen. And since the last peak of the cycle, each player, being SK Hynix, Samsung, and Micron, has voiced their new supply strategy, which is essentially just to meet demand trends, not to try and seek scale benefits, not to try and ramp up production, but just supply as much as there is demand for their memory products. And the result of this will hopefully be, a margin expansion over time if the cyclicality starts to die down. And the 5-year average is around 10 times earnings at the moment. We're currently around 18 times earnings. So it could expand quite easily from that 5 to 10 year average and still be, a fairly low multiple relative to the rest of the market. And so there's, a high level of what the thesis, or what I believe the thesis to be for a lot of people in Micron. But what does this look like in numbers? And of course, with the numbers being quite complicated and hard to predict, we do have a DCF that I've done here, and it does show the company being fairly undervalued, but with it being an unpredictable company with unpredictable earnings and cash flow, the DCF isn't going to make a huge amount of sense or be that reliable. But the way in which I'd like to look at this is by forecasting where I think Micron may be in the next sort of 3 to 5 years potentially, either at the end of their cycle or out of the legacy cycle completely. If we take the current trend and say that they will at some point outgrow their prior cycle high of $15 billion in their income, I'd say with the tailwinds and the tighter supply, we could reach close to 20 to 25 billion in the next sort of 4 to 5 years. That might be a little bit of a push, but the secular trends behind this company are so strong that it could quite easily be done. That would likely need close to sort of 50 billion in revenues in the next sort of 5 years based off some steady state margins and then being near the peak of their cycle. Now, if we couple this with the reduced cyclicality thesis, which is essentially going to improve the understanding of the business, the appreciation of the business, and therefore the multiple that the market are putting on this business, then the IRR packaged all together starts to look very compelling. If we just put potentially a 10 times multiple on this 2025 expected pre-tax income of 20 to 25 billion, then we get a market cap of close to 200 to 250 billion in 2025. So just in 4 years. Now that estimates anywhere from a 20% to a 25% IRR. And not to try and scale up or get too bullish, but if we say that multiple sustains at around 15 times, it's currently at 18 times, then we get a hypothetical range of anywhere between 300 billion and 370 billion, which actually implies an IRR of 35% plus, even from today's level where the market cap has got to around $82 billion. Now, where is all the downside protection in this? If the valuation multiple sinks because investors fear the cyclical downturn just after the potential peak earnings that it might reach here, well, part of that could be buybacks. You see, at the peak of their cycle last time, they had the ability to buy back around 25% of the total market cap just through the leftover free cash flow that they had. And this was something that David Tepper was calling for them to do. And they didn't, but instead they sporadically bought back stock at different times and held some of the cash on their balance sheet, paid back some debt, which was probably a good thing for them to do at the time. It has made them more durable. But they have said going forward that they will be much more opportunistic in their approach to buybacks and returning money to shareholders, potentially trying to buy back the stock if it ever gets to a significantly low multiple where they can buy back a large percentage of the market cap in one go. And this should provide the stock with some much needed wind if the valuation starts to sink low in the future, like we saw back in 2019, 2020 when it was a P of around 6 and the market cap was really low relative to where its earnings are. That new buyback initiative should see the stock lift even in a case where that multiple reduction happens. And so that is the thesis for Micron, guys, at least how I see it and why I think a lot of these super investors see it as a big opportunity right now. I have done a deep dive on Micron in the past, going through the business, its business model a little bit more. So if you're interested and need to know more about the business, then go ahead and watch that. I will link it down below. For disclosure, I do own some Micron stock myself. It's become a fairly large position just because the price has almost doubled from the original cost base, but I'll admit I initially just bought on cheapness. I think it was a P of like 6 or something like that. But as I've owned it and looked into the business more and more, I've become more compelled to hold the stock and even potentially buy more at the moment because it looks like one of the better opportunities in the market. But if you want to check out all of the stocks that I own as well as my buys and sells, you can do so by joining the Patreon. I will leave a link in the description below. With that, you'll also get access to all of my valuation models, including the one here that we've got on Micron. Plus, you get access to the Discord community and other exclusive analysis and content. So go ahead and check that out if you're interested. Apart from that though, guys, if you like this video, please leave a thumbs up. Let me know in the comments what you think of Micron and subscribe if you want to see more content like this. I'll see you all in the next video. Good luck with your investments.